Episode 2 of Benjamin's Boot Camp. Today we're going to be learning about liquidity. And don't click off yet for the intermediate and advanced traders. We're not just learning about basic liquidity. We're learning about the different types and some advanced concept knowledge about liquidity. So watch the whole video. It will be worth it. Let me take off my headphones because I don't know why I have them on. There's two types of liquidity: internal range liquidity and external range liquidity. Now, there's more in-depth analysis on liquidity, but those are the two main types of places price is going to go to take out. Now, what do I mean by internal and external? Internal range liquidity is like fair value gaps, where price will gap down or up. You know what a fair value gap is. And it would leave a lot of liquidity there. Price will then go down to rebalance that fair value gap, and it will take internal range liquidity. So every time you see price trade into a fair value gap, the reason why it's moving lower, the reason why a fair value gap is considered a PD array is because it's a form of liquidity. The markets move off of liquidity. So they go down to take liquidity and then go up to take liquidity. So if price is going to go all the way up just to hit a fair value gap, that fair value gap has to have some sort of liquidity for price to move down back lower without taking some sort of highs or lows. So fair value gaps and internal range liquidity, PD arrays, are internal range liquidity. Now, external range liquidity is highs and lows. Equal highs, equal lows, relative equal highs, relative equal lows, whatever. I'm going to get more in depth on what liquidity is, but just take note that there's two types of liquidity, internal and external. And they're both used for relatively the same thing, but also very different things. Now, I'm going to jump in, and I did not do any analysis before this on the markets. I don't have like a book to jump to a specific time on this chart to show you an example. I know liquidity so well, and you will need to get to this point too, that you can just randomly open the chart, find a drawn liquidity that is so good, and then use it to teach someone, because it happens every single day. Now, I don't know what these blue boxes are on my chart, so you're going to have to deal with it. It's not an indicator. It's a trading view bug that's happened for a long time. But let's just draw out what external range liquidity looks like. You can see that we have relative equal lows here, low here, and low here. These are also higher probability for what reason? Not just because they're equal lows, but because it's formed during Asian range. Now, why does that matter? Asian range tends to be the accumulation of the day. What did the markets move on? Accumulation, manipulation, distribution. So accumulation of orders, consolidation, manipulation, so a fake move to trigger people, let's say it's going up, trigger people taking longs so then they can drive price back down lower. So that accumulation of orders is them engineering your take profit. The manipulation is them faking out people to take long so then you can catch the short and then use that equal lows from the Asian range from the accumulation as your take profit and get out of the markets. In days where you can see relative equal lows and price doesn't take it, especially during Asian range, that is possible. It could be a very bullish or bearish day. But those are going to get taken eventually. As you can see. Oh, I just spilled, bro, my Pepsi tower just spilled all over me, bro. Fuck. All right, I'm going to finish the thing and then clean that. So, bro, this is what the mentorship is going to be like. You can see that we have these relative equal lows. Price moved up way higher and then gapped up quite a bit for a new day opening gap, continued to accumulate, and then moved all the way down lower, and now it's drawing to these equal lows. So I'm going to anticipate that tomorrow, why did my camera shake from that? I'm going to anticipate that tomorrow we're going to go and take down these equal lows. But there's cases where we don't do that. So you can see here, these relative equal lows down here. Now, this is either being engineered for later, and we're going to continue down there, or we could reverse here and leave these. Because the NASDAQ is a stock goes up most of the time. Not right now. There is a possibility of equal lows being taken. So whenever you're trading and you see equal highs or lows, and don't tunnel vision them. Don't say, oh, there's equal highs no matter what. I'm just going to take longs. Because I made that mistake too many times, and a lot of traders make that mistake of seeing equal highs or lows and only looking for that as a target when they totally forget the higher time frame and be like, we're going down lower, ignore those equal highs. That's actually a form of rejection. So equal highs can be two things: engineered liquidity or it can be rejection and you can continue down lower from that and you don't need to take those. There's a lot of equal highs that we have all the way up here that we formed that traders can be like, oh, we're going to go take that over here, over here, over here, and just lose because they lost sight of the higher time frame narrative. Now, lower time frame liquidity is here. Higher time frame narrative is here. You need to have your narrative for everything else to work, not vice versa. So if you see relative equal highs or lows on the lower time frame, remember what your target is. Then if this matches your target, then you can look for something targeting those. But let's go to the daily chart and figure out why these relative equal lows were left open. I don't know about you, but this looks pretty bearish to me. We have the tariff news. We have so much bearish news going out in the economy right now. The markets have been bearish, trend bearish. And this is a little bit of a tricky situation, so it involves a more in-depth analysis. But you can see here that we have internal range liquidity, the fair value gap, that price traded to and traded away. So people can think that this could be a reversal. Now, with my personal analysis, I don't think this is going to be a reversal. I think we're going to take some sort of liquidity and then trade back down lower because we have this massive new week opening gap here. But and sorry if I'm talking in too big of words, I'm going to simplify it a little bit more. Right now, we have external range liquidity down here. Price is trading up higher to take internal range liquidity on the higher time frame. But what's internal range on the higher time frame is external on the lower time frame. Now, write that down and be careful and really listen to what I'm saying here. Internal range liquidity on the higher time frame is external range liquidity on the lower time frame. Now, why do I say that? Well, a fair value gap requires highs and lows, right? So let's draw out, this isn't a fair value gap, but let's just draw out a box here of this volume imbalance. And let's look, there's a high there. Although that's not a swing high on the daily time frame, if we cut to replay mode and drop down to the 5 minute, I think it was right here. That's a high on the lower time frame. That's lower time frame external range liquidity. But on the daily chart, there's only a swing high here, and that's it in this whole rally. But then we go to the 15 minute and you look at the whole rally, how many swing highs, how many external range liquidity highs do you see here? So when price is trading into even down to the 1 minute of a fair value gap, it's still taking external range liquidity on the lower time frame. Now, pay close attention to why you are going the way you are going. When you're trading the higher time frame, really focus on what are you doing. Are you rebalancing or are you hunting stops? Now, when price will trade and rebalance, it tends to not have that long of actually, I could be wrong. But it tends to not have that long of an accumulation stage in that fair value gap. It tends to go up into it and then down. But when price takes a form of liquidity, right, it tends to consolidate a little longer, then trade down back lower, targeting the opposite side of liquidity. So when you are in low resistance liquidity run, it's not a good example because I'm on the daily chart, but let's just go over to, I'm in replay mode, sorry. When you're in low resistance liquidity run, like this. And what is low resistance liquidity run? Low resistance. So it's just going down, 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 or up, up, up very fast. You can anticipate that the first internal range liquidity that gets traded to is going to react off of price. Now, there was only one fair value gap here. But if you look here, there's 3. But the last fair value gap that was formed in this range, the first one that was presented right here, is the one that price reacted off of and traded lower. Now, why was that? It's because we're very bearish. So every time price goes higher, it doesn't need to take highs. It can just trade into a fair value gap. And why is this key to note? The reason why it's key to note is because every time you trade up higher, that doesn't mean you're reversing. So what may look like a reversal on the 1 minute, like a market structure shift fair value gap on the 1 minute, might be a fair value gap fill on the 5 minute. For example, people that traded in this range looking for longs and probably saw a market structure shift in this range, and they probably took a long. Now their long failed because they probably failed to realize that it was just trading into this fair value gap, then continuing down lower. So let's jump into replay mode and try to find and see if there was any setup there. Boom. There's your answer. Low, high, lower low, higher high, fair value gap. People probably took this long. Look, even the bodies respected consequent encroachment, the middle line. So a lot of people probably took this long. A lot of intermediate and even advanced traders probably took this long because it's tempting, right? We wicked below these lows. It's during like 10 a.m., which is a silver bullet hour. Market structure shift, fair value gap, bodies respect consequent encroachment is high probability. But remember, you don't lose the higher time frame narrative. Don't be tunnel visioned on your entry. The entry is 10% of your trading model. What happens? All it's doing is taking a form of internal range or external liquidity on the lower time frame, but internal range liquidity on the higher time frame, which is the 5-minute, accumulating and then trading lower. And you lost your trade because of that. Now, what is the indication of figuring out that price is going to respect the 5-minute and disrespect the 5-minute fair value gap when you catch a 1-minute trade? Speed and the way price moves. Price here, right? Once it trades up here, it should have kept going. But when you see it slow down and start to body below 50% of that fair value gap, like look at this. Look at that wick. When you start to see things like that, when you start to see things like this, where this body closed under the middle line, this body closed under the middle line. You spent 10 minutes consolidating under the middle line, under consequent encroachment. That's a clear indication of price is going to continue down lower and respect this fair value gap. I made a video about it today talking about how consequent encroachment is a key indication of price moving down lower. So what people thought targeting, relative equal highs, right? External range liquidity. A fair value gap. Let me put this back into replay and just show you how tempting this looks in real time. How tempting does this long setup look in real time? If you're watching this video right now, go to the comment section and tell me that you wouldn't take this trade, like that you would take this trade, and be honest with me. Be honest with yourself and be honest with me. Would you take this long setup? It took a form of sell side liquidity, probably at SMT. Right? You can clearly see a super clean type of setup here. Sell side liquidity taken. Market structure shift. Fair value gap. Trades up higher. Breaks the high that it formed trading into the fair value gap. Relative equal highs. A lot of people, a lot of smart money concept traders probably lost in this trade because they failed to see that look how long it's taking to trade up higher. Now, why is that? Because it was already taking internal range liquidity. So it didn't need to take external range liquidity. It took a form of liquidity and it's going to move lower. That's why you need to pay attention to both types of liquidity, not just equal highs or lows. A lot of these gurus on social media say equal highs, equal lows, they're so powerful. When in reality, yeah, they're powerful, but like they're not that powerful in the wrong narrative. Price could just be rebalancing an internal range liquidity, a fair value gap, or other internal range liquidity PD arrays, and then move down lower. A PD array is a price delivery array, I think. Maybe I'm wrong. Call me out if I'm wrong. But this is the reason why this trade lost. And if we zoom out a little bit, you can see that we already took highs. We've been so much higher in the day, right? Accumulation, manipulation, distribution. And you can see that we're in a premium of the day, and this wasn't going to work. On top of that, we were in this 5-minute SIBI, sell side imbalance, buy side inefficiency, 5-minute bearish fair value gap. It took too long to react. You should have caught yourself, closed your trade in a little bit of profit, and got off the charts. So that is internal versus external range liquidity. That is targeting, knowing when it's going to be internal and knowing when it's going to be external. This is a very important topic to learn. So I recommend going back into the video if you don't fully understand it. I'm going to simplify it really quickly. External range liquidity. Write this in your notes. External range liquidity. Relative equal highs or lows. Equal highs or lows, or a high and a low. Internal range liquidity. PD arrays. Fair value gaps, inversion fair value gaps, volume imbalances, new day and new week opening gaps. Now, if you don't know what those are, you will learn about them in this boot camp and then come back to this video. That's why I recommend watching this boot camp multiple times. But it's very important to note what is external and what is external and what price is going to react off of. That's why when you see price consolidate after you took your trade, you should most likely identify that as low probability and either cut risk or get out. But as I fell victim to this as well, as a lot of traders fail to do, is identify that because they're so tunnel vision on their trade. They're already in a long and they're like, oh, let me just stick to it. When in reality, they need to really focus and pretend like they're not even in a trade and use proper analysis and figure out why is this failing. Now, this, on the other hand, is a break of structure, but it's also a market structure shift. So you can see here, if we get rid of these and we draw out our 5-minute fair value gap, how do we find the short? Bodies respect consequent encroachment, which is that middle line, right? You can even target up here, which is taking internal range liquidity. So price takes internal range liquidity, displaces lower, breaking structure. What does it trade to? A fair value gap. What does the bodies do? Respect the middle line, consequent encroachment. We trade down lower and then take out these lows. And price is, before you take an entry, price needs to take a form of liquidity. Everybody says that, but they don't think about it enough. A form of liquidity can also be a PD array. That's why ICT says that it's either needs to take highs or lows or trade into a higher time frame PD array, not a lower time frame PD array. Your narrative needs to be from the higher time frame. And why is that? Because higher time frame, lower time frame, right? Whatever is driving the higher time frame, the lower time frame is going to follow, but also create different opportunities. So that's liquidity summed up for you, basically. I hope you got a lot of notes. And if you do need a little bit more help on liquidity and understanding liquidity, there's a lot of YouTube videos you can research out there. But what liquidity is basically about orders, or where there's a lot of money in the marketplace and where price is going to draw to. Price is always based off liquidity. So if it wasn't, the markets would just go straight up. But because price needs to take lows before it goes up higher, you can see price go like this, right? Right now, what are we doing with this tariff stuff? Taking a lot of liquidity. What does that mean? We're going to go up a lot higher because of this move. Now, will we do that in the next month, year, 2 years? Who knows? Because you look all the way at the 2008 crash, 2000 crash, it took a long time to rebalance that crash, but we went so much higher after. We went so much lower in the 2022 crash, but we went so much higher because we did that. So when you see price move so much lower or so much higher, you can anticipate that could be manipulation and then catch an even bigger move to the opposite side. The markets run off of liquidity. It's the number one thing you need to learn about in trading. And I'm going to be going in depth on other PD arrays in my boot camp. And this is the first video. I hope you guys enjoyed it. Also, if you're an intermediate to advanced trader, I recommend watching the easy videos like what is a fair value gap, because I go in depth. This isn't just a beginner boot camp. You really need to focus on everything here. And I will be releasing notes. I also have a private community and Discord where you can learn the most advanced type of concepts. Again, we have so many notes. What is a candle? Teaching for beginners, as well as expanding your knowledge for intermediate traders and different types of PDFs. We have live streams in here and everything. So I recommend joining that. We also have a lot of more content on the WAP, and we have one-on-one free video calls with me, myself, for subscribers on the WAP. You can see that in the link in my description of this video. And I hope you guys found this video insightful, and I will see you guys in episode 3 of the boot camp. Next topic, I still got to think about, but it might be fair value gaps. I think it's going to be fair value gaps. It probably will be fair value gaps. So I'll see you guys in the next video. Peace.